Okay. Wake up, motherfucker.
What's up? What's up? What's up? All right, let me check. Everything's good here. All right, audio good. All right, good. It is May 5th. All right, 2026. Okay, so we got another good stock to look at, CIFR. So I've been waiting for this one to report earnings. It opened up like a little bit, 2-3%, and then we had a little dip, and then they bought the dip within 3 minutes, and after that it just went up the whole day. So by the close, CIFR was up 20%. And I know you guys are gamblers. I guess you want leverage. Yeah, they have leverage ETFs for CIFR, and that's up 40 something percent. There you go. Okay. Let's see. AMD didn't crash. Did it report earnings already? I didn't really see any activity there. So uh, it was up like 1%. Is that was that earnings up 1%? Is that all the earnings we're gonna get for AMD? AMD has already been way pumped, way pumped already after Intel and all that. Like, okay, it's up 3%. I mean, how much more can it go? How much more can these things go? They keep going to Intel to pump the whole damn thing up. It's like Intel, Micron, Intel, Micron. Like the rest of the semiconductors are like, whatever, just go to Intel and back to Micron. Go to Intel and back to Micron. That's all they're doing, man. It's just two stocks pumping. I think right now Micron might be worth $1 trillion at this point. So, like, who cares, dude? Like, dude, it's overcrowded. Forget that stuff. We're going to AI infrastructure, man. You got HUT, you got IREN, you got all those things. All that money that's in semiconductors has to go somewhere. They got to go somewhere. Okay, you see that? Ooh, that's a beautiful candle right there. Beautiful candle right there. That's what you want to see. This is what you want to see. So this was the only pullback we got for this stock. That's it. Okay, adding this stock to the list. All right, once it breaks out, right, we're going to go to 25 plus. Once we get past 25, there is nothing in the past to block us. Okay? Nothing in the past. This means this thing will be chased. Once we get past 25, people will chase it because they'll get bored of Intel and Micron. They'll be like, Intel's only up 15%. That's boring. Micron's only up 8%. That's boring. This stock here is going to go up 20% each day until like we run out of liquidity. That's what I'm looking for. So all that money that's in semiconductors, you can take it. Okay? So you didn't need to be in semiconductors. You can still get their money. So the people that are in semiconductors, they'll look at these stocks and they'll chase it. They have enough money that they'll chase it. That's how it is. It's all psychology. It has nothing to do with reality. Who cares about reality? All I care about is people are greedy and they'll get more greedy, right? They already made a lot of money on Micron and SanDisk and Intel, and they'll be looking at this and they'll be very, very greedy. Very greedy. So yeah, we got to go into these type of stocks. Well, that's why you don't short. So that's why I put the thumbnail, don't short. If you short, you don't put a lot of money into it. And if you do, you get out as quickly as possible when you make money because this is a bull market. This is a bull market. Like I got here, right? Friday at the close. I got over here after Intel pumped this sucker up. And then we went down, and when we went down, and this was just before Jerome Powell and all that stuff. So once we got here, it's done. Okay, you're pretty much done here. All right, you don't get greedy. All right, unless this thing broke through the 40 moving average here on the 78-minute. So when you look at the 78-minute, actually let me show you the 1 hour. You see the 1 hour looks a lot different, right? It probably would have went down here and you would have kept holding because it's below the 40. But if you look at the 78-minute, it's a lot different, you see? So this is the reason I use 78-minute. I'm like, I want everything to be divisible by 5. Everything has to be fractal for me, perfectly divisible by 5. So you have 5 candles per day. You have pretty much like 4 to 5 candles per month, okay? And that's how it goes. So that's it. I want to keep it like this. If I do the 1 hour, I get 6 candles, right? Well, actually 7 candles, right? Because we have 30 minutes. Uh it's not divisible. So yeah, so that's why I don't use that 1 hour. I use 78 minutes. Now you get why I did this. Okay? Now you get why I did this. Once you get here, you get out, that's done because you got to have follow through. If I don't see follow through, why do I bother with it? Okay? That's what you got to do. Same thing with MSTR. MSTR I shorted too on the Monday. So when it did this on this Monday, it went up in the morning and then midday it went down and then I said, "Okay, I'll short it." Because it couldn't hold its liquor. It couldn't hold this purple line here. That's it. So you use the moving averages as a guideline. That's all it is. These are just guidelines. Kind of like, well, there's a good opportunity that it has to go lower, especially when it makes this kind of pattern here. Let me take this away. Right? Let me just take this away. Let me take all of it away. Just look at the candles. Look at the candles. Just look at the candles, okay? Look at the way it behaves here, right? Just look at the candles, okay? So, yeah, let me hide everything again. Okay, so look at here during the day. You have a strong day and it holds most of the first candle. So you look at the first candle of the day and you see how it holds. You look at the first candle, it's not holding anymore. First candle of the day, it's down. It stays below most of the range set by this candle. First candle of the day, it goes up, but it loses it all and holds down for the rest of the day. That's when you know, like, it's about to puke. That's it. When you look at the first day, so when I look at this, look at today. This is why I don't like MSTR. This is why I like IREN, I like HUT, I like all this stuff because, like, look at it. The first candle of the day down, but it doesn't recover and it stays below most of the time. So the bottom half of this candle. That means it's going to go lower probably later on, you know? Um it's just weak. Yeah. It's just weak overall. Yeah, because it doesn't have AI. This thing can only pump on Bitcoin, okay? HUT can pump on Bitcoin and AI. Right? Look at this. Today, it's down. The first candle of the day, the first 78 minutes. But then look at the rest of the day. It recovers. It's trying to recover. It's trying to recover. And then the end candle is up. So it should be going up tomorrow. There you go. That's it. It has a different structure. So if you want to look at something, look at how they do in the day, during the day. Like, does it go up or down during the day and how it's structured? This is good. Look at this one. It goes down on the first 78 minutes of the day. But then the rest of the candles, it goes and recovers. Good. Good. You want to see that. So it's ready to move up. So this one should be, if earnings is good for HUT, it should go up. Okay. And we should be fine. So that HUT, IREN, and Core Z. Okay. Now, a lot of people on Twitter have been yelling and screaming about why semiconductors went up, blah, blah, blah. Yeah, no news, blah, blah. It doesn't need news, right? If there's no bad news, it'll just go up anyway. That's it. That's all it is. All right, AMD is up 7% right now after hours. So let's see if it holds. Lumentum is flat. It was down 6%. Now it's flat. LITE. Lumentum is not semiconductors, but it's AI related, right? So it will affect semiconductors too. But I'm just like, whatever. I don't really care about semiconductors. It can do whatever it wants to do for now. Eventually, all the money there will go over here. This is where we're going to look at. All right, Core Z, all this stuff. So today's winner is CIFR. Perfect. We got earnings. So this is it, baby. Oh, yes, this one. So we have a fourth player in the list. I also added APLD very good today as well, up 12%. It has leverage as well. APLX is the leverage. For CIFR, there's CIFG and CIFU leverage ETFs. So if you want to gamble, go ahead. Gamble away. I think this is enough gambling for me. APLD going up 12% in a day, CIFR 23%. I'm happy. If you guys want 40, 50%, okay, knock yourself out. But if this thing reverses, you're going to eat it, right? You're going to have to eat it. Leverage increases your risk. All right? It might not, dude, Iran, the US, they could do something overnight and you're going to be like, what the fuck? What and then you're back down. So be careful. Anything can come along and ruin this. But for now, everything's setting up perfectly. Bitcoin setting up perfectly. All the software is setting up perfectly. Okay, and you have to pick the specific stocks to win, because we can see Palantir earnings pushed it back down. Like I told you yesterday, I said it's either going to break out and we're going to go past 160 or we're going back to 135. We're back to 135. We're here again. But should you buy now or wait? Because I think you have a better chance of just sticking with other names for now. And I rather focus on IREN and the other ones. So if CIFR did well, then HUT tomorrow morning and IREN Thursday afternoon, those two will be the ones to look for pushing up. If all those three go up, then Core Z will be the last one to report earnings. This one probably next week or 2 weeks. I don't know. We don't have a date yet for Core Z. But once this is done, I'm assuming this will go up as well very high, because look, we're almost at the tippity top. The high was made in November, and we're already up here. Once it cracks 23 on Core Z, it'll go up. So all these will go up very high. Very good. IREN usually has, most things you will. You know what? It's all about the perception. That's why I don't play earnings. I don't care about earnings. I just look at the chart. I see a breakout. I chase it. I'll go up. I don't care. That's it. That's all we need here. So yeah. Perfect. APLD, CIFR, perfect. So there's plenty of room to go. We're close to the final breakout time. All that money in semiconductors is going to get out. Okay. This is done. Are you going to tell me semiconductors is going to go up another 20, 30% from here? I don't think so. And you can see, like, when it went for Intel, you see how far it moved from the moving average here. You see, you can put standard deviations on this. You could be like, okay, if you look at this line, this purple line, you can put like 1 standard deviation, 2 standard deviations from it, right? So you see most of the time it's hugging the purple. And then when Intel earnings came out, it went a little bit too high, huh? And then on Monday, it just sold off, because it's probably a good time to sell off. It has to get back to the purple line again. And then it went below the purple line, but, it recovered and went back towards the purple. You can just look at it like that. So now we're at the point where, look at that. We're getting far away from the purple again. So it's going to have to pull back. I think eventually, if it breaks the yellow line this time, so this time, last time it didn't break the yellow, but let's say it breaks the yellow, it breaks this orange dotted line I put here, and then it starts drifting down towards here. Where's this money going to go once it gets back here? Well, has to go somewhere. So I'm going to say it's going to go to APLD, CIFR, HUT, blah, blah, blah. That's it. And then we're going to zoom. And every day is going to be like 20%. It'll be easier to push those guys up than Intel, right? Intel is a big company with a lot of shares. It's hard to push it up 20% every day. All right? Very hard. But somebody's been doing it. And guess what? 20% movement in Intel. And if it goes down 20% over like the course of a month, equals like 50, 60% in the course of a week for all those other stocks we've been looking at. So should be easy. Should be very easy to pump. All right. Money likes to flow, man. Money likes to flow. So that's it. That's all I got to talk about. Core Z tomorrow evening. Oh, okay. Oh, is it? Is it confirmed? Do we have confirmation? You got to give me confirmation, like a press release. If I don't have a press release, I don't know what it is. Because a lot of people have a lot of dates that's just like arbitrary because they just estimate the dates. If that's true, then we don't have to wait. So we don't have to wait and we get everything. Okay. So we'll be done this week, right? We don't have to worry about earnings anymore for these stocks. Oh, 8 days, never mind. Okay, I don't know. I'll double check it. But all I saw was like everything except Core Z. I think APLD already reported, right? It reported long ago. So APLD should be done too. We're done with all these. Yeah, it reported way early. So we're done. We're done, guys. We don't have to worry about earnings ruining the party. Once this stuff starts going, boom. We good. We good. Yeah. Yep. We good, man. Nothing to worry about. I hate earnings. Honestly, I do not like earnings. It always ruins the party. I like to play stuff after and before their earnings. You get a lot of money before and after their earnings. You don't need to play the earnings. You just don't know how it's going to react. Okay? Because it's based on people's perceptions. As you can see, people's perceptions change quite quickly. See? Before they're like, man, why should I buy semiconductors? And then all of a sudden, everybody should buy semiconductors. It just changed within a week, their mood. Stock market is very fickle. It's full of people that just follow the trend. And if the trend is going somewhere else, then I follow it. That's trend following for you. Okay, that's it, guys. Oh, the other thing is Cloudflare. Cloudflare will release earnings as well. This one, not exactly AI, right? It's just communication services. So, I mean, you know what Cloudflare is. Every time you go to a website, it tries to confirm if you're a human or not. So, it will report earnings. I don't know why it went up today, but it went up 9% today for some reason. Okay, whatever. I guess it's like semiconductors. Nobody knows exactly why they went up today. I guess if there's no Iran stuff, it'll go up. So it's about to break out of the last high in November. So watch this one. It also has a leverage ETF, NETG. Okay, I had this on the list already for you guys long ago. And that's it. I think we're done here. Don't need to talk about anything else. As far as Korea, I don't know how far Korea is going to go. I think a lot of the reason why we've been pumping the last 2 days is overnight, Korea pumps up, and then in the morning, the U.S. markets open, and then they just follow Korea. Every time they just keep following Korea. So it's like we go up, then Korea goes up overnight. Then we just go up and follow Korea. And it keeps doing this for the past several trading days. It's just like Korea goes up, then we go up, then we go up, Korea goes up. It's just like, oh, okay, whatever, guys. I got no idea why you guys want to keep pumping the semiconductors, but if you guys keep doing this, because Korea is essentially all semiconductors, okay? So the Korean ETFs like EWY and KORU leverage ETF here of EWY, it's 50% of the ETF is now just Samsung and HK Hynix. So semiconductors and memory. That's it. So like people came out with this DRAM ETF recently. You don't need DRAM ETF. DRAM ETF is just basically Micron and HK Hynix. So you could just buy the Micron stock by itself and add to it EWY, and you'll get DRAM. You'll get the same thing. It has very little SanDisk, okay, and Western Digital. It's mostly it's like 90% just Samsung, HK Hynix, and Micron. So you don't need that ETF. So I don't know what's like. People are so lazy they just have to buy an ETF, I guess. All right, whatever. Okay, there's already 2 ETFs that'll give you this ETF. It's like what the hell? Why do I need this DRAM ETF? Okay, waste of time. You're just paying fees for something that's already there. Okay, guys, that's it. All right. I play whatever has best spread, highest liquidity. Yeah, yeah, yeah. I guess. Well, yeah. When you do options, you have to worry about that. That's for sure. Um, Cloudflare is so yeah. Some ETFs, like a lot of times, ETFs when they get released. I mean, I don't know if that ETF has a lot of liquidity right now, but if they got a lot of interest, it creates huge pockets of liquidity for you when you play ETFs. Yeah, so you don't need to worry about options on certain stocks if you can just play the ETF. How long can we stay in data centers? We have as long as June. We can go up for another 3 weeks at least. At least. If the move is very strong and nothing is happening in Iran into early June, then maybe 2 more weeks, because then we'll have to worry about the options again because we have quarterly options expire the third week of June, right? So people are going to worry about that. Also, the Fed chair will talk again between now and that options expiration. So people might be worried before he starts blabbering. So this will be the first new Fed chair, uh, FOMC. So maybe they're worried what he's going to say because they know what Jerome Powell always says. So they got used to Jerome Powell. Now we get a new Fed chair. The market might sell before he talks. You know what I mean? So that's why when we get a new chair, the first 2 months of a new Fed chair, stock market usually goes down because they don't want to hold stocks with a new guy. They want to listen to him first and go like, "Oh, this is how he talks. This is how he manages the press conference." And then the algorithms adjust and then they know how he behaves, then they get used to him and then it's like no surprise, then it's fine. But usually when you get a new Fed chair, yeah, the stock market generally goes down. Yeah, because they have to they have to learn how to like I guess interpret how he says. That's what they call Fed talk, right? They talk out of their mouths but do something else, stuff like that. They kind of have to tease him out a little bit. Okay, let's see what else. Volatility crush. Yes, volatility crush. That's earnings for you. Hate that shit. Um Second candle on MSTR was bullish. Yeah, I don't know. MSTR. Ugh. You see, this is another problem with MSTR, right? It has to get through all this stuff here. All these red candles here have to get bypassed. So idiots that were buying here were underwater all the way into February, March. And then now it's about to break even for the guys who bought here. So every time we get to these zones, it's just going to be like, ugh, painful, right? So this is going to stop it from moving cleanly up unless Bitcoin like goes wacko and moves back up to 100,000 very quickly. It has to move quickly into it. It's a momentum thing too. Like MSTR, if it wants to go up, a lot of times it's not just the Bitcoin price. It has to be the momentum of Bitcoin. If Bitcoin starts going sideways again, guess what? This thing will just drift back down because they get bored of it. They don't like things going sideways in this type of stock. They're just like, oh, yeah. So that's just how it is. That's a psychology thing. Okay. Anything else? Done. Okay. Good. Yeah. Master Kim. Yeah. You could put $10 in something else and maybe it'll quadruple for you in these stocks. And if you use options, I'm sure it's more crazy, right? And as far as Rubio, I don't know what he's saying right now. I don't think it's going to be anything significant. There's covered calls in Bitcoin ETFs. Oh yeah, they have those covered call ETFs. Yeah. That was kind of a recent thing, right? They started making these covered call ETFs everywhere. Man, yeah, I don't look into those very much. Um, Usually I just go into T-bills. So then you just go to the T-bill ETF, like this ETF here. You can go to the T-bill ETF. You see this one? Okay. So you see why it behaves like this? It's because they give you dividends. Every time they give you dividends, it does this. So you can buy the T-bill ETF the day before the dividend payout or 2 days before the dividend payout. I forgot the rules, but something like that. And so if you adjust it for dividends, so I click this. So on stream on TradingView, you go down here and you click the adjust for dividends and it looks like this. You see that? So this is what Warren Buffett is probably in. So yeah, it's so if you just buy a T-bill, and you just go like this, do 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 do, or your brokerage for you puts you in money market funds for you automatically, and you don't need to do this. It depends. Like if it does it automatically, you don't need to do this. If it doesn't do it automatically, then all you have to do is the day before, the 2-3 days before dividend, you just buy the ETF, you get your dividend, and you get out. That's it. Very easy. Okay. Yeah, that's what you do. Anyway, pro tip. That's a pro tip right there for you. The other way is you just buy T-bills directly. If you buy T-bills directly, the benefit from that is that when you get your coupon payments, quote unquote dividends, I guess you can call it a dividend, um, it's not taxed by your state. Okay, so if you're in a high income state like me in California, that might be the way to go. So, the only drawback of that is you have to hold it over a month, right? So you can't cash it out early. The Treasury Department holds your cash for a month before giving it back to you. Okay, that's it. That's it right there. But if you're in Texas, you don't need to do that. Okay, so or some other non-income state tax, state. Paper savings bond E series. Yeah, I have one of those when it was like 20% or some crazy thing during COVID. Yeah. Um, it's not 20% now, but it was 20% or something. It wasn't 20%, but it was something crazy. I know that. Uh, yeah, there's announced day and last day. Yeah, it's like ex dividend day, right? Ex dividend. Yeah, something like that. I had a bunch as a kid. Oh, okay. Okay, that's cool. That's a good way to learn. You start understanding how bonds are done, right? Yeah, ex post dividend. Yeah, something like that. Yep, exactly. You can Google it. Just Google it. Yeah. Okay. What else? What else? That was it. That's all we're focusing on. Anything else? Palantir down, right? Okay. Who cares? Okay. And we talked about that. Anything else? Nope. Nope. Nothing else here. Nope. Let's see. AMD is now down up to 4%. Okay, it's not 6% anymore, 4.4%. Whatever, we'll figure that one tomorrow, how that goes. Okay, last thing I want to talk about was Moderna. Okay, so Moderna, this one, okay, last week it had earnings on Friday. It looks like it's not making a new low. Do I want to buy it over here? We'll see. We'll see. I like this one. I think it's getting ready to go, but it might still be too early. Like we can wait on the biotech sector. So if you look at the biotech sector, XBI, it's been very healthy since Trump tacoed in April. You see, we finally got out of this range here. Very good. So I have a feeling if the new Fed chair is nice to about interest rates, then we can go up, but he might not be. Okay. He might not be because a lot of this movement here will be dependent on if interest rates are not going to stay high too long. So we might have to wait for the Fed chair to talk. But if that's going to be good, then yeah, you have a chance to get. So we can do Lab U. You can have a 3X ETF here. And this thing we might play in October. All right. So this thing might have a chance to really fly up here. How high can we go on this one? I don't know. Let's see. Let me see. Let me see. Well, I don't know if we can get back to the COVID high. Maybe we can. If people are really this dumb, yeah, sure, why not? That's 30%. Okay. 35%. Okay. Sure. So that's 115%. Okay. So this can go up from 187 to 400. Okay, cool. All right, cool. Why not? Maybe that's what's going to happen. mRNA should be going up pretty well too. All right. So that's something else I'm looking at. The other things too. Oh yeah, aluminum today, or aluminium if you're British, Aussie, or Canadian or whatever. Okay, so aluminum, CSTM. What was it? Yeah, it went up today. 6.87%. Was there some news? I don't know. But it had earnings last week, so let's see. Oh, it was initiated by UBS. Okay, thanks UBS. Thanks Swiss Bank. Thanks for pumping it for me. So I like aluminium and I like steel right now. All right. And later on, we can look at lithium and then uranium. Okay. Copper can wait. Copper is not, it's probably still not, yeah, it can wait. Copper can wait. We're not getting anywhere with copper. So, all right. So those are the stocks on the list scrolling at the top of your screen right now. So you see those stocks, aluminium, steel stocks that I picked out. Marijuana, it's gonna take a while. Okay, I don't know if it's gonna break out now or later, but I don't think it's gonna break out now. So we can wait on marijuana, and then we have the CMPS, Peter Thiel, psychedelic drugs. Okay, so this one's still floating here at 9. So this thing, Moderna and XBI Biotech, once we get going, whoop. I mean, I don't know if it's gonna go back to 50 like it did in COVID. All right. It IPO'd in COVID. And then after that, it just fell. It's a good time to IPO, right? You IPO when everybody is bullish and then all the insiders get to get out over the year. So it IPOs in 2020. It gets a year for people to get out of there, and then they get out. And then what happens after that? Oh, yeah. Ukraine, Russia, Jerome Powell raises interest rates and it goes down. So if we lower the interest rates sometime next year, maybe we can bubble our way up before it's the end. You know, I heard there's an ETF that will have SpaceX in it. Man, what is it called? MAG-P. MAG-P. I don't think it's out yet. Is it out? No, it's not out yet. So there'll be a new ETF called MAG-P, MAGP, which will have SpaceX. So we'll see. We'll see. There's a lot of IPOs, bro. ChatGPT is gonna IPO. SpaceX, right? With Twitter, right? Again. So I think Elon wants to put SpaceX into Twitter because it's XAI, right? XAI plus SpaceX. And then we have Anthropic. You have ChatGPT. And then I heard that the S&P, the Standard and Poor's, will change the rules. So what they're going to do is they're going to allow those big IPOs to be put into the S&P 500 right away. So they're not going to wait. They want to put those 3 IPOs into the S&P 500 immediately. So all those 401ks will automatically buy Anthropic via the S&P 500, right? ChatGPT via the S&P 500, SpaceX via the S&P 500. It's over, bro. It's over. The bubble is going to start. We're going to have 1998 into 1999. Yes! That means we can make even more money. It'll be so easy to make money, bro. I love bubbles. I know Warren Buffett hates bubbles, but I love bubbles. Bubbles is how you make the most money quickly. People are so dumb and they'll allow this to happen. Yes. Yes. This is going to be great. I can't wait. How do we cash in on it? You don't need to do anything. You just buy the S&P 500. You'll get it all. They'll put it in there. Oh shit. Yes, yes, I love it. Oh man. I don't get why people hate bubbles, man. I lived through 1999. It was a great time. You just need to know when to get out. That's all. That's all. Okay. Good. All right. Done with this. Okay, guys. I don't think we need to look at this anymore. We're good. We're good to go. Okay. Okay. I think everybody's looking at the damn Korea right now. They're going like, "What's up? Oh, look at Korea. What the hell is Korea doing?" Bro, Korea ain't anything. Korea ain't anything. Call open interest. Yes, let's buy calls in Korea. So this is what you're gonna see in a bubble, man. Korea. Oh yeah. 42% of EWYs in Samsung and HK Hynix. Yeah, see? So I said, like, why you have to buy DRAM ETF? Just buy the EWY ETF and you'll get DRAM. And then you just need to add Micron. That's it. One ETF, one stock, and you'll get the DRAM ETF. So this should be fun right there. Holy crap. Yeah, there's so much stuff going on. Man, these people are insane. Yeah. Anyhow, let me look at my bookmarks. I got some bookmarks. Okay, HK Hynix, I don't care. I think this is interesting. Nvidia and Pulte Group are partnering with startup Span to install mini data centers on the walls of new homes. Wow. You know, that could just be like solar cells. Solar panels. You remember solar panels? If you remember, like, what was that called? Sun Power or something like that. Elon Musk's cousin was running that company. I bought Sun Power stocks to get back into Tesla cheaply because it was like X number of Sun Power shares, I would get Y numbers of Tesla shares. And because of the way that Sun Power was priced, it was basically equivalent of me getting Tesla shares back at a discount. And then I just bought a whole bunch of Sun Power shares and I got back my Tesla shares because I sold Tesla like months before, and then there were rumors that like Elon was gonna bail out his cousin, and I just bought a bunch of Sun Power or whatever. I forgot. Solar City. Oh, it was Solar City, right? It wasn't Sun Power. Solar City. So Solar City shares, and then I would get back my Tesla shares that way. I wonder if this is going to start another financing bubble where people are going to get financing just to put data centers inside their walls. Oh my God, this is great. This is going to be a scam for sure, man. Because then there's going to be a lot of credit that's going to get pumped out. Ooh, great. I wonder how you're going to make money off of this, bro. There's going to be so many loans out there that will never get paid back. Shit. If there's a company that can offer because a lot of those solar panel companies had financing with it, right? So it would sell you the car and it'll sell you the loan. That's how cars companies make money. So I'm sure there's going to be this Span. I wonder if Span's going to have an IPO. Dude, if there's going to be a lot of companies that want to get in on this, like financing for data centers to be put in your walls, yeah, maybe this is it. This is going to be the new scam right here. Let's see here.
We were just talking about that mandatory Google AI download. I think you may have put. Yes, I did. I was like, bro, why is Google trying to destroy my memory here? So, yeah, let me put this on. Let me put this on. So I get this. You see why I use ad blocker? I use ad blocker not because I block ads, but I block the memory usage from the ads and other scripts that they run in the background. So there's a bug that people said that YouTube would take up all your RAM. Like each YouTube tab would start draining 2 gigabytes of RAM or something, 4 gigabytes of RAM. So there's a bug in there. And then Google was installing like 4 gigabytes of some AI stuff in your hard disk. I was like, what? Are you a-holes just trying to pump up all the memory stock? So here's this: Google Chrome silently installs 4 gigabytes of AI model on your device. No consent, no opt-out. Reinstalls itself if the user removes it manually. This is why I hate Chrome. Chrome is such a terrible browser. You know, for that reason. I stopped using Chrome like 5 years ago because I noticed that every time I open a tab, it would use way more memory than every time it updated. So every time there was a new Google Chrome update, I noticed like it had terrible memory management. And then now we have this YouTube website currently affected by a major bug that causes individual video tabs to consume over 7 gigabytes. Holy dude. Users are experiencing severe lag, frozen tabs, and in some cases, entire browser becomes unresponsive. So I guess if you use like a TV, a smart TV, you won't have this problem, or your mobile device. But if you're on a computer, it looks like, yeah, this is a problem right here. The issue stems from an endless loop in how the interface handles the action buttons below the video player. So the like button, the share button, and the save button. bro. See, this is exactly why these memory companies are gonna make a killing. The code is so bad. Oh my god. I think a lot of that. I think people, the Chinese with that deep, was it DeepSeek or whatever? What they did was they made their own drivers for the NVIDIA graphics card. So they figured out a way to directly access the memory, the VRAM in the GPUs, so that it would use the memory more efficiently. So I think there's a lot of terrible code right now that's way overusing what's necessary to run AI or whatever is on your computer. So yeah, it's just poor coding practices, you know. Oh yeah, DeepSeek, right? DeepSeek. Yeah, DeepSeek. That's right. Yeah, DeepSeek. Yeah, all code's been shit. Yeah, but it's just getting worse, you know. The abstraction layers are so much now. When I learned the code, it was like I have to learn assembly, I gotta learn C, not C++, not object. I'm not hiding anything through an object, or I have to do low-level coding. I directly access the memory, allocate the memory myself. Now it's like, oh, the operating system has, virtual memory. It takes care of that for you. Well, duh. And then now you don't even do that at that level. Now it's the browser that takes care of it for you. Now I write code for the browser, like StreamYards, like I'm using right now, StreamYards, a web app, basically. And now I'm abstracting it even further. So I'm trusting that Chrome or whatever browser you're using, like Safari, can actually handle the memory correctly. Probably not. And so there you go. Waste even more memory, you know? All right, that's enough of that. What's up, Ugg? What's up? Okay, that's enough of that. End my rant. I don't think here's a thing you should know. I will not short a bull market. 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 Okay, guys? I think Michael Burry added to his short today. So Michael Burry bought more puts for semiconductors. So he bought his puts at the same time I shorted with SOXS, but I got out. He bought more shorts today. So he's not giving up. Okay, he's going to keep shorting those semiconductors. So who cares about that? Blah blah blah. Okay, I think that's it. I don't think I need to read anymore. We don't need to go over this. Blah 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 blah. Nope, 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 nope. Oh, this one's good. This one's good. This one's good. This one's good. Um, so you should follow Gina Martin Adams. She's very smart. Okay, she's very smart. You'll see her on Bloomberg TV from time to time. I don't know if she goes on CNBC, but I see her on Bloomberg sometimes. So equity risk premium. Okay, here. So she says the current ERP, equity risk premium. I think we talked about this maybe a month ago. I don't know if you remember, but I don't. Oh man, I got to go over the definition or whatever. Okay. We don't need to go over the definition, but hear me out. Okay, equity risk premium. Okay. So this will go in with the Warren Buffett stuff, right? Isn't necessarily worrisome for forward equity returns. It's roughly on par with the pre-2000 norm, which accompanied an annual 14.8% rise in the S&P 500. The long-term average rolling annual gain is 8.1%. All right. So what does this mean? If we're going to have a big .com like bubble next year, that means we're about to enter that regime. Okay, so look at the light blue line, right? So we're now at around what 1.8% or whatever this is, just below 2%, whatever it is. And then when it went to the peak of the .com bubble, it was negative. It got negative. We're not there yet. So even if this thing starts drifting lower, we're still okay. All right. So this is one way to know that it's time to sell, right? Once we hit negative on this equity risk premium metric, that's another signal to say, oh, we're at the top. It's time to bounce. The bubble is about to be done. Okay. Now, here's another reply by this guy here. He said this: stocks look expensive by any sensible measure, while the 10-year Treasury yield sits at 4.3%, higher than at any point during the 13-year rally that followed the global financial crisis, great financial crisis. Subtract the bond yield from the earnings yield, the inverse of price to earnings ratio. Okay, I think we talked about this too about maybe a month ago. Of the S&P, and you get what Yale University's Robert Shiller, we talked about this, the PE, the Shiller price to earnings ratio, calls the excess CAPE yield, CAPE. For over a century, this offered a great guide to how equities would fare over the ensuing decade, and it currently suggests that this is an unappealing time to buy into the market. So this is like another way to say that this is Warren Buffett's reason for not buying anything, right? He's selling his stocks into this bubble. But for us, we don't care about bubbles because we are going to ride this bubble, okay? Do you agree? We should forget about fundamentals right now because if we are entering the state where we are in a bubble, we should ride it for as long as we can until we see the signs that the bubble is over. So look at this one. The excess CAPE yield is just hovering just above zero. It's not negative yet. The .com at the peak, that blue line, went negative. So that's another way to show that it's time to get out. All right? So don't be afraid of bubbles. We just got to ride it and just go like, we gotta just wait for these signals to go negative and go, okay, it's time to leave. Bye-bye. And then we talked about the other way to look at the bubbles too, with the margin, the FINRA margin data. All right, that's the other way. So there's many ways to look at things where we could say, okay, the bubble is over, but we are about to enter the bubble. We are about to enter the bubble. It doesn't mean that we're going to get a bubble, but if we see the bubble happening, we got to do it. We got to ride it. Okay, and then so it'll be a mania. It'll be insane. All the stocks will act like crypto, and we'll just have to accept that fact and ride it up. All right, so hopefully that's good enough for you guys. Okay, so I think you know now when to get out of a bubble. So we're about to get into the bubble, and we know when to get out of the bubble. Okay, yes. Maybe, yeah, maybe that's what's gonna happen. More semiconductors, and Michael Berry is gonna get blown up. Yeah. No, I don't do options. I just use the leverage ETFs because they made it easy to get leverage ETFs. I don't use margin accounts either because like I have like like $1 million spread over different accounts, right? So I can just trade without a margin account. And now like the SEC allows you to trade within a day. Your money gets cash settled within a day, right? It's T+1 now. It used to be T+3, and then before T+3, it used to be T+5, right? And in the 90s, it was like T+7 or something. Oh man, that was terrible. But you don't need a margin account anymore. You don't need that. So yeah, so I don't need options because options for leverage I'm not going to use, especially when I don't really understand it. I don't want to understand it, honestly. It's just like, fuck, that's just too much work. Okay. All right. So let me see if I got some videos to play. I have some videos to play for you guys. So I'll take a break now. Oh man, you're doing 0 DTE. Oh, see, when they started doing 0 DTE, I was like, you guys are on crack. You guys just wanna gamble, man. 0 DTE. That's why the VIX doesn't work anymore. The VIX doesn't work anymore because the 0 DTE guys got into the game. So you can't use the VIX to predict like a crash. People used to use the VIX, the volatility index, to predict crash, but the VIX measures the implicit volatility 30 days out, right? 20 to 30 days out. And if people are playing 0 DTE, then the VIX can't measure that, so it's useless as an indicator, right now. And but I'm not an options expert. All right, so you can talk to Jem Carson. He's an options expert. Okay, so let me play this thing. Let me pay this boomer bond trader here, Jeffrey Gunlock. He's always depressing. So let's hear the bear side. Let's hear the bear.
Let's bring in our headliner, as we always do. He's Jeffrey Gunlock. He's the CEO, the CIO, and founder of Double Line. He joins us from Los Angeles, as always. Welcome back. It's good to have you.
Good to be with you again, Scott. It's been a while with Jay Powell. It's been a long ride. I think this is our 43rd time talking about the post-presser situation. I think the words of the meeting, certainly legal battle, was something we haven't heard before. And he wanted to take a parting shot on that, it seems. But also, it's a little bit hawkish on...
Are you talking about like the Tom Lee? Yeah, I talked about Tom Lee a couple times. You could go back to my previous streams. I talked about Tom Lee. Yeah, I played one of his old interviews back in 2001 or 2021. Yeah, I think it was 2021, December, Christmas, just before the crash. So you should watch that one. That was very interesting. And on my Twitter account, let me see. I got the image here. I posted this image, which is really a cool image because I played that old 2021 interview for 2 images here, and I'll put the one that you should be paying attention to. All right, let me see if I got it. Let me see. Man, do I have it in this folder? This folder. Okay, here we go. Oh, you just imagine me as Tom Lee? Yeah. I wish I ran like a little fund and just like go on TV to babble on for you guys. It'll just be like, here we are. This one. Take a screenshot, okay? Let me get rid of the banner. Take a screenshot of this. So, I like to talk about cycles, right? So when you look at generational cycles, it's like about what, 25 to 35 years between each generation, right? So when you get a peak of working age people, in the labor market, so you see what he's doing, right? So he's getting like a 5-year percent change of adults between 30 and 48. So when we get like a boom in 30 to 48-year olds, we get a lot of people in the labor market, then they spend money, right? They're consumers now. They have money to spend. So you look at the boomer times, it was like 1975 into 1990s to the 1990s, right? And then now we went from 2010 into the 2030s. So based on this, we're at the end of a bull market if we have to wait for Gen Z to start making money and take over as the new consumers. So the millennials, people my age, right? So I'm late millennial basically. So you can see here, I'm like at that 48, right? I'm at that 48 mark. We're about to go down, okay, as consumers. Gen Z has to take over, and you can see like that turn of that blue line, and then at the bottom you can see like the rolling gain of the S&P 500, right? So we back in 2021, you see the dashed orange vertical line, you see, and he gave 3 projections. It's like we have like one projection showing that we're going to move up into the red bubble area. We have one that's flat, and we have one that's going down. Right now, because of COVID and then all the pumping we've been doing, we are still going towards that red line. We are about to hit that red line. We're going to go bubble time. We're going to go bubble. And this is where we're at. I think we're just about to cross that red line for next year. And I think sometime next year into 2028, that'll be the end. All right. We're just going to roll over. Okay. My prediction was late 2026, but because of all the shenanigans that's been happening, I'm willing to say that 2027 can have a big bubble, but maybe not. Maybe late 2026, we're just going to fall and go straight to the ground. But if we survive this year, we're going to have a nice bubble in 2027. Okay, we'll have at least one more good year. If the bubble is good, maybe 1.5 years into 2028. So take a screenshot of this. All right. But we're not talking about Tom Lee today. We are going to play this guy, Jeffrey Gundlach, bond market extraordinaire. He's a Debbie Downer. He's bearish. He's always going to talk bearish. So here.
Misbehaving. And he said, if you blinked, you missed it. But he basically said if the tariff effect doesn't fade in the next quarter or two, and if oil prices, remain challenging, we won't even think of reducing interest rates. So it's not surprising that we saw rates back up, the yield curve flatten in a bearish fashion, with 2-year Treasury yields going up about 10 basis points after that meeting. And now the 2-year Treasury yield is above the high end of the Fed funds rate. It's almost at 4% now. I suspect it will go to 4%. And it looks like the 30-year Treasury is settling in, moving up to about 5%. So the bond market has started to price in higher inflation, lasting longer, and we think that's absolutely appropriate. We think that based upon the commodity complex right now, that the year 2026 will end up in the high 3s for the headline CPI. And we might even see, based upon where oil is right now, and that will affect inflation for the next couple of months, we might see a 4 handle on the CPI. And that's in a month or two. And that's clearly suggests that the Fed cannot be cutting interest rates.
Right.
So it's been an interesting period in the bond market. Treasury market's been so stable. Yields haven't really changed in a year at many parts of the yield curve. And year to date, virtually every bond sector that's a traditional sector, like high yield, bank loans, investment grade, mortgage-related securities, treasuries, they're all negative on a total return basis, particularly with the down prices today. And so the only thing that's actually up in the bond market is local currency emerging market debt, which has a small positive rate of return in the context of other bond sectors being, in worst performers, bank loans down about 2.2% on the bank loan ETF, and everything else is down about 0.5% or so, and it's been very, very stable. I don't take the stability in the interest rates as likely to endure for the remainder of 2026. It's just been stable for such a long period of time. Last year, we were marveling at the fact that the WTI curve was predicting no change in the oil price. Going forward a year, the oil price was projected by the WTI curve to be $56 plus or minus $1 for months on end. And then all of a sudden, that stability got completely shattered, obviously, by the war situation. And so now oil is up tremendously. So the number one performing asset class, if a traditional asset class really, is the Bloomberg Commodity Index, which has had a tremendous run this year. It's up a tremendous amount. Mm-hmm. But I think investors should hold on to commodities at this point in time. I'm not really that fond of gold in the near term. It peaked out at about 5,500. And after the vertical rise up from 3,500, I wouldn't be surprised if gold went down below 4,000 before resuming its rise higher.
You know, there's this other guy, this other macro guy, UG. Oh man, what's he called? I put his blog up and I talked about his blog a few times. This Australian guy. Oh man, what was his name? What is his name? Fuck. Russell. It was something Russell. Okay, let me see. Russell. Let's see. Blog TLT. So he believes that gold will outperform bonds. And I think he's right. Russell Clark. Okay, Russell Clark. Okay, yeah, let me see. RussellClark.com. He has a Substack. You can go to his Substack. Okay. Or something like that. Here you go. Some of it's paywalled, some of it's not. You could check out his non-paywalled stuff. And I don't like to listen to too many macro guys because they kind of have an infatuation for their thesis. So I believe gold will outperform bonds, but this year, gold is not going to outperform bonds, I think. So there's going to be a time like this year into next year, bonds will start going back up. So you could buy TLT or whatever if you want. And gold is just going to continue sideways. So there's going to be a time where bonds will start outperforming gold. But at some point, something's going to break where gold will just start shooting up again. Okay. So what would that mean? That would mean like there's a big problem with the petrodollar and the United States status as the leading empire, I guess. You could call it an empire, basically. So something's gonna break it. I don't know if it's China. People say it's gonna be China. Maybe it'll be something else that'll break it. The EU, whatever. But at a certain point, it will break again and gold will keep going up. Okay. So maybe next year, late next year, early, that will probably coincide when the stock market will go down. Maybe some kind of event will shakes people's confidence in the dollar. If that happens, people won't go into US Treasury bonds. So if we're talking about US bonds, no. If we're talking about bonds of other countries like China, EU, maybe. You know what I mean? It depends on the bonds too. And that's why I kind of feel like it's a good time to start looking at international stocks like Brazil, Mexico, kind of like those type of countries that will play a big role into deciding does the US win or China wins, right? So Mexico, Brazil, there's going to be like these big Latin American countries that will just be like, well, we will favor China more than the US now, or we'll favor US more than China. So they'll start being more interesting. Yeah. So, yeah, Vietnam too. Yeah, there's definitely going to be something with Vietnam. Vietnam's been booming for quite a while. They have a very good growth rate out of all the Southeast Asian countries outside of like Indonesia, Malaysia. Malaysia, Indonesia, I don't know how they compare, but Vietnam is kind of like the leading one. Southeast Asian stock called Grab for a minute. Never heard of that one. But we'll see. We'll see. So, yeah. So you see Jeffrey Gunlock here, pretty much a Debbie Downer. He just doesn't believe in the markets. So let me show you this before I continue playing him. So I showed this before. I showed you guys this before. So I do the spread between a 3-month and 2-year yield. So whenever I start seeing like this huge move down, right? You just see this huge move down on the 3-month versus 2-year yield on the US Treasuries. Okay. So basically a T-bill, 3-month T-bill minus a 2-year note. If it starts moving down significantly, then there's a dip in the US stock market. This one is very significant back in 2021. You see back in September, it started going down a lot. And this was like months before Jerome Powell said like he gave up on transitory inflation. He gave up on it. He said like, well, I think inflation is more sticky than I thought, so I better raise interest rates. And he said that in November, right around Thanksgiving. And then from then on, the market started going sideways into New Year's. And then after New Year's, everybody sold because they were waiting for the year to roll over so that they could sell in 2022 instead of 2021. So they didn't get the tax hit for selling way too much profit in 2021. And then you see like it really starts sinking, this whole spread, the 3-month versus 2-year. This is a bear market. That was a bear market. So now we're kind of on the cusp of breaking this line. I drew this line, 0.5, negative 0.5 for the spread. And you could see like every time we got below 0.5, it kind of meant that the S&P 500 wasn't going to have an easy time to go up. It was like sideways or down, sideways or down. So watch this level here. If this thing starts going below 0.5 when our new Fed chair comes, then that's the bear case. Then you believe Jeffrey Gunlock. If this doesn't happen, then you believe in the bubble. You believe in Tom Lee. So you got two camps, Jeffrey Gunlock, Tom Lee. If you want to believe in Tom Lee, then this spread does not go below 0.5. Okay, that's your tip right there. Okay, 3-month minus 2-year.
So I had been recommending that investors own a commodity index, like the Bloomberg Commodity Index type of thing, and also a little dollop of gold directly in there with the XAU or whatever it is, and you could have an overweight to gold. I don't recommend that right now. I think there's going to be a cheaper entry point, but commodities broadly certainly seem strong. Obviously, that's been powered by the energy sector.
Sure.
Since the war started.
Yeah, you would, as you would expect. So on both of those notes, Jeffrey, the dissents to which David Kelly earlier, and I know you respect his views and you cite him often in our conversations, called those the Fed's declaration of independence as they look ahead to a new chair and in a sense holding the line, saying we're not going to be moved by any political winds or anything else that are blowing in the direction of wanting us to do one thing or the other. So what was your take on that before we get to Powell's decision to stay?
Yeah, I mean, I think they cleared the decks, really. You know, they've been having this easing bias, and I guess they still have that in the statement. But based on the press conference and those 3 dissents, it's pretty clear that they want to be truly sort of viewed to be neutral in terms of a bias. They say there's an easing bias, but it didn't feel that way in the press conference. I felt like there's more of a tightening bias at this point, and that's married as well to the 2-year Treasury heading towards 4%. I mean, that's suggesting that there should be a hike sometime between now and the end of the year. I remember in our earlier visits here in the first 2 Powell press conferences, I pointed out back in January, I didn't think there'd be a rate cut this year. And now and then last time we met, I said if all you got for wanting risk assets is that you're banking on 2 rate cuts this year, you're backing the wrong horse. And that has certainly turned out to be the case. I mean, the warp function that looks at the shape of the yield curve suggests that there's just no rate cut this year. And I wouldn't be surprised if it started skewing towards a rate hike.
So you see, Jeffrey Gunlock, being that pessimist, he's like, "Oh, there's gonna be a rate hike. Let's see. Okay, we haven't heard from the new Fed chair yet. Yeah, transitory. It was like, create a bunch of money and put everyone out of work. Exactly. Yeah, I'm definitely a conspiracy theorist. So I believe everything happens for a reason. So should I wait until the morning to buy? Hut will report in the morning. AMD is up 7% right now. All right, semiconductors at least will pump overnight. So let's see how it holds in the morning. Wait until the morning. Everything happens within 30 minutes of the open. That's my philosophy. You can always just wake up 30 minutes before it opens. So for me, I'm Pacific time zone, right? I wake up around 5, 4 o'clock, whatever, in the morning, and I look at the pre-market, then I look at like that, and then within 30 minutes of the open, I make my move and go back to sleep or nap or I go freaking jog or something. I don't know. It depends. And that's it. Okay. But generally, any overnight movement gets wiped out anyway. Yeah. Well, sometimes not. Right now we're very bullish. So a lot of that overnight move will move up. Sometimes there's a big overnight pump and it disappears by the open before the open. So who knows? It really depends on the news cycle, right? They always set the news cycle before it opens. Like the Axios, like they always do. They always say something like 4 hours before market open. The market open. Yeah, they always do something. So if there's some bad news, they'll say some good news 4 hours before the market opens. So there's some bad news that happens overnight. There's some good news. I don't know. It's all BS anyway. I don't think you really need to care too much about that if you have a trend. Right now, the AI will have a trend. Yeah. So because all that stuff is short-term manipulation. It's easy to manipulate overnight because the volume is thinner. You see what I mean? So the volume is a lot thinner, so it's easier to pump or dump overnight. Like you've noticed that. I told you guys to buy Monday, right? That Monday, and then it's like the Sunday, it's like it's going to go down, but then they start pumping it right back up just before the market opens. It's like, dude, if we had that dip at the market open, we could have got way more things cheaper on Monday morning instead of like, oh man, everything's crashing Sunday afternoon, and it's like by the time market opens, it's gone. Very annoying. So in the title of my stream, there's a list of stocks right there. That's one list. If you go look at the description, let me take a screenshot right now. So okay, let me get this right now here. Okay, let me just screenshot this for you. Okay. All right. But it's risky though. It's risky right now. It would have been easier if we just had a dump over the weekend, but we didn't get that. So oh man, it's too small. My bad. Hold on. Hold on. That's way too small. Shoot. Okay. Let me put it on a paste bid. Let me put it in a paste bid. Okay, understand. Da, da, da. Okay, let me see. Blah 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 blah. I got that. I got that. I got that. Okay, okay. All right. Let's do this. And I'll go over it one by one. One by one. Okay. All right. Let's go. Okay. Okay. So CIFR is up 20% today. I don't know if you want to buy that yet. Okay, hold on. APLD up pretty good, 10%. Okay, those two are good. Okay, but you might have to wait a while. So CIFR, APLD. Doc N, I'll talk about after I play this video, had earnings this morning. So this is really good for the software side. There are 3 stocks that will report the software that I'm watching. AKAM, Akami, FSLY, Fastly, and then NET, NET, right? So that's Cloudflare. So DOCN already made a brand new high off of earnings today. I think it was up 30% at the close. Whew. So that's good. That means like people really want to get back into software. But not every software stock, right? Not every like communication service stock. Like Shopify went down this morning. Pinterest, PINS went down this morning. So not every earnings will be good. Some earnings will be good, some will not. And I'm waiting to see which ones will actually pan out, and then we can go into those. But right now, the 2 that I like, CIFR, APLD already reported earnings. APLD already reported earnings 1 month ago. And then after that, we can look at these other guys. Oracle, right? Oracle I already have. I might buy more. And I use the leverage one, ORCX and ORCU. Oracle is ORCL. Okay, this plain Oracle. And we'll go from there. That's it. And Adobe too. Adobe. ADBE. Okay. The other ones that I'm waiting for are these cybersecurity ones. They got beaten up because of Anthropic. Crowd. Oh my God. What is it? I forgot. Palo Alto Networks and what was it? CrowdStrike. See, I always confuse CrowdStrike with Cloudflare. Cloudflare is completely different from CrowdStrike. So there's 2 leverage ones for the Palo Alto Networks, CRWL and PALU. So those are 2x leverage. So yeah, the normal one is CRWD right here, yeah, and then the other one is PANW, yeah. Okay. This content is bull mammoth repellent. Yeah, bull mammies are not going to talk about this shit. The bull mammies. Ah. All right. Continuing on.
Numbers start. If we get a 4 handle on the CPI, I think there's going to be a lot of people talking about inflation is not close to 2%. I mean, inflation on the core CPI actually tracked for a couple of decades, right along.
God, what a Debbie Downer! What a Debbie Downer!
We had 2 or 3 years of, on average, 5% inflation, and in the years since 2023, it's averaging 3% inflation, and we're going to go into the mid-3s at a minimum as we move forward in 2026, based upon this energy shock. And so I just don't think that there's a case for an ease between now and the end of this year, unless something bad happens.
Do you actually think there could be a hike?
Sort of a shock.
Forgive me for interrupting you, but do you actually believe there could be a hike?
I think the odds of a hike between now and year end are better than the odds of a cut, and I think that's going to come further into focus as we move forward. This oil situation is just going to last longer than people are hoping for. Brent is up at $120. A lot of the actual transactions that are not in the futures markets are at higher levels than that, and there's a real problem here. And so we know that the food prices are very likely to go up once again, because fertilizer prices are way up, and of course the cost of transporting the food items is going to go up substantially. It's already gone up, and it's going to be sticky based upon this enduring war. You know, they always say the boys will be home by Christmas when we go into a war, and it never seems to be the case. So I just remember the Ukraine war. The idea was that Russia was just going to roll over them in 2 or 3 weeks, and that would be the end of it. Here we are years later, and we're still involved there. People have forgotten about that. The other issue that is on my list of worries is we've blown up a lot of our weapons stockpiles. You know, like the Tomahawks, we've fired a third of the stockpiles. Some of the other missiles, we've blown up half of them, and it takes a while to recreate this stuff. I saw a comment that someone from the administration or a government official anyway was saying that if China wanted to get aggressive on Taiwan, it's not clear that we would be in a position to mount a defense if we so decided to do, because our weapon stockpile is so drawn down. So I think that, unfortunately, I think this oil spike is going to be with us for quite some time. So and that means that the inflation forecasts have to go up.
So if they do, I mean, what does that mean for Kevin Warsh? And what kind of Fed chair do you think he'll be?
I think he's been clear on one thing for sure, and that is he doesn't like forecasting the future or giving hints of what the Fed's going to do. He doesn't seem to like the dot plots. I don't like the dot plots myself. I think it's almost embarrassing that every time they do a dot plot, they say in 2 years, last time it was 3 years because they had to back off the 2 years, but always used to be in 2 years, inflation will be at 2% per the dot plot. Now, this time it was in 3 years. But I think that he's going to not want a lot of, I think he might cut back on the press conferences. That really wouldn't bother me that much.
Whoa. You're gonna back off on the press conferences? I heard that rumor too. Like, he doesn't want to do so many press conferences anymore. Whoa, dude. If he does that, the market is going to freak out because you're changing how much information you're going to give the public now. You're going to hide everything. Oh, that's not going to be good. So yeah, I don't know what's true and what's not true about this new Fed chair. What's going to happen? What's up, Buster Hoonihan? Yeah, what's up? Yeah, no problem. Yeah, you didn't know it's live. Don't worry about it. Let me show you this. So he was talking about food inflation. I'm very big on the fertilizer stuff and the food stuff. Okay, so we will definitely start talking more and more about that as the weeks drag on. But right now, AI is going to be more important into the summer. But in the back of your mind, you definitely want to look at wheat, soy, corn. Okay, so we're going to have to look at that stuff for sure. There is going to be a big push. And I already mentioned like 2 fertilizer stocks about 2 months ago, and by now it should be about 2 months, right? CF and IPI. So CF and IPI will be the 2 that I like. I saw IPI go up 6% today. I don't know what news drove that one up, but I might add more. Or maybe it was like no, it was LXU. LXU went up. No, my bad. It was LXU, not IPI. So CF and IPI are the ones that I told you guys about for now. CF is my number 1. IPI is my number 2. LXU might be my number 3 because it went up for some reason today. I don't know why, but it went up. And here, let me show you this chart. Let's see. Where is it? Here it is. Okay. Yeah, so built to spill. There's an ETF for you. If you can't do commodities futures, you can buy this ETF. And the good thing about this ETF, it doesn't have a K1 tax form. If you get a K1 tax form, because a lot of the commodities ETFs like natural gas, gasoline ETF, oil ETF, wheat, soy, corn, whatever ETFs, they give you a K1 tax form. It's annoying because you have to manually figure that out. TurboTax and whatever doesn't do it. If you have an accountant, it probably doesn't matter. You make your accountant like, oh, okay, whatever. If you have like a really good accountant, you're like, you figure it out. But if you're doing your tax like me, I do it myself. Honestly, I try to do it whatever myself. K1 tax forms are really a pain. It's like such a pain. You just can't. Oh my god, it's such a painful. So there's an ETF. It doesn't give you a K1 tax form. It's nice. Okay, so no KF tax form. This is the United States. I don't know what happens if you go outside the United States. There's probably some other ETF for you. Oh my god, the tax. This is the reason I don't do crypto, because the tax. I do taxes myself. I don't want to deal with that. Oh man, yeah. So yeah, I know. Yeah, it's a nightmare. I bet it's a nightmare. Holy shit, it's a night. So yeah. So there's a TILL ETF, no K1. Okay, TILL. Okay. So TILL contains soy, corn, and wheat, but it doesn't. But it also has sugar, which is annoying. I don't want sugar in there, but it has sugar. So I can do Schedule C. Yeah, Schedule C is easy, but when you have the K1, oh my god, fuck that shit. It's so painful. Because K1 is basically a limited partnership. Okay, so the reason they do that is for some weird reason they just don't want to deal with the taxes on their end, and they shift the labor into the people that buy and sell their ETFs. So they want you to deal with it. So people, so the other, yeah, if it does silver and gold futures, so when an ETF tracks futures, for some reason they don't want to deal with the tax headache, and so they make you do the tax headache, and then they shift it to the K1 form, and then you have to deal with it. It's just like, what the fuck? John Galt has you blocked? Are you sure? Are you sure? Let's see. I mean, what no. If you're watching on the Give Crack to Me channel, I'm multi-streaming right now. That's me. That's me. I'm multi-streaming. So I'm multi-streaming on this channel, and my Kick channel. No. He's not blocking. That's not him. That's me. So if you're watching on Give Crack to Me, yeah, you're not gonna see that chat. So anyway. Yeah, so yeah. I don't know how you crypto guys do it. That's one of the reasons I didn't do crypto. No, it's me. Yeah. So this chart here, you can take a screenshot of it. Okay, this chart. So what it does is that grain prices. So the corn, wheat, and soy follow 15 months ahead of gold. So that's one of the reasons I was bullish on gold. I mean, bullish on oil at the beginning of this year, was because gold went up already, so oil follows, and then the grains, the food, the commodity foods will follow, right? And I think you guys know that beef is very expensive because they didn't grow their cattle. So there might be an ETF you want to track if you want to follow beef and pork prices. Chinese like to eat pork. If the Chinese economy actually gets out of this deflationary spiral they've been on, you might see pork prices start rising too. So beef and pork might also be something you might be interested in. But for now, I'm only interested in grains. So soybean oil has been going up. The oil has already been going up for soybean. They have meal and they have the grain, and that will follow suit. So yeah, so TILL is the one you want to get into. So okay, TILL. If you don't want that K1 form, but the problem is you have sugar in there. But I think the sugar prices are already spiking now because they're using sugar to replace ethanol from other grains and oil, and from to replace the petroleum too. So sugar is being used as fuel in Brazil or something like that. I don't know. So sugar prices might have bottomed already. So sugar might be going up. So that might be fine. All right.
I think every 6 weeks. I kind of like it when the press conferences, when they skip a meeting, you know, like in the summertime. So you actually have a little bit longer period between the meetings, so you get more information. I think there's a little bit too much information that comes from the Fed, frankly. Too many opinions. I think he's going to want to be more of a primary spokesperson and discourage other Fed governors from, speaking their mind on something of a regular basis. And I kind of favor that. I think nobody knows the future. Nobody knows what's going to happen 2-3 years from now on the inflation rate and the unemployment rate. You just have to work in real time. He's spoken that way, and I respect him for that. I mean, I liked Jay Powell. I didn't think it was the best Fed chairman ever. I thought he was too late. He was certainly too late on hiking rates in 2021. I remember when they finally went to 25 basis points, I said, Painter, get off the ladder. Let's do 200 basis points right now. And then in 2024, they were way behind the Treasury bond market. There was 175 basis point spread between the Fed funds rate. The 2-year Treasury rate was 175 basis points below. And amazingly, after all these rate cuts, 175 basis points of rate cuts, the yield curve is up since the first rate cut by the Fed. Since the day of the first rate cut by the Fed, the 2-year, 5-year, 10-year, 30-year, they're all higher. And in fact, the 30-year Treasury rate has never been lower since they started cutting interest rates. It's been higher the whole time, most of the time by about 100 basis points. And I've been talking about how I don't really like the long-term Treasuries. I'm a little less strident in that opinion right now. In fact, today, after the announcement and after the bond market sold off, we actually bought some Treasuries, intermediate-term Treasuries. I didn't buy 30-year Treasuries, but we bought some Treasuries in the sort of the middle part of the yield curve, thinking that even though inflation's going higher, we've got rates now that even if inflation goes to 4%, you buy the 5-year Treasury, you're actually getting higher than 4%. And you roll down the yield curve on that, so you might get a little bit of a gain just by the passage of time. So I do think the chances of a rate hike, because of the inflation problem, which Jay Powell used the word misbehaving, I think the probability of a hike is greater than that of a cut.
Wow. I like the real-time trading activity, too, that you're bringing to our viewers as well, as you're sort of taking in everything that they are in real time. You mentioned, let's call them the Powell misses. Too late, the transitory mistake, obviously, is well documented. But what about the hits, so to speak, and the things that he got right, and how that will influence, in your mind, how he should be judged in the totality of his reign as Fed chair? The worst, health crisis in 100 years. The worst inflation to deal with in 40. The tariffs, the supply shocks, which he himself today said we've dealt with for the last 6 years, and navigating all of that, and how he should be judged in total.
I think when it comes to the economy, the stability of the economy, he's right to take some credit for that. That's a success. That with all that you referenced, you really didn't have a recession. Now, of course, the money from the government caused the inflation, and I think he could have fought back a little bit more on that. But the fact that there was no, other than the couple of months there when the economy hit the elevator shaft down, I mean, I think it's to his credit that the economy has been very stable, and the unemployment rate has not really gone up, in spite of the fact that there's been a lot of dynamic shifts in the labor force and the immigration going to emigration, forced emigration. I think the fact that the unemployment rate still has not accelerated above its 3-year moving average is to his credit for having. He's balanced the mandates pretty well against very challenging conditions along the way. So I give him credit for the fact that the economy has been robust, frankly, more robust than virtually everybody, including myself, thought that it had any right to be, given all of the challenges.
What do you make of his decision to stay on? And again, this sort of defiance that really sort of he exuded today when talking about what he sees as an assault on Fed independence, which he called at risk.
Yeah, well, he held his tongue for many of these press conferences when people wanted to dig into the tension here. And he always said, I'm not going there. I don't have anything for you there. And I think he just felt that he had this was an opportunity to directly speak. I mean, when the first question came out, I think it was Steve Leisman's question, I think he went into reading a written statement about the legal attacks and how we got to get back to norms and all this sort of stuff, which is typical of mainstream politicians. They always want to talk about norms because norms mean that they stay in power. But I thought that I thought that Jay Powell was. I liked the way he handles him. I liked the way he handled himself. I think it's fair enough that he said he spoke his mind on. He doesn't think that this is a path to be going down, and particularly with the regional governors and stuff like that. I agree with him on that. He says it would be the beginning of the end if we started removing, for political reasons, Fed officials and governors. And I really agree with him on that. I mean, that I would just have the Fed funds rate set at the 2-year Treasury, and that's kind of where we are. It's a little bit higher now, but I like the fact that he kind of pushed back a little bit. I give him credit for that.
Do you at all worry about what the likes of Ray Dalio has been talking about of late? I know you care deeply about the deficit and the long-term ramifications of that, but Dalio earlier this week said of the economy, as resilient as it still may be, and Chair Powell sort of doubled down on his belief that it is, said that stagflation is already here, that we're in that era, that it's already arrived, which means that Kevin Warsh's Fed chair is going to have a potentially more difficult road ahead if we truly are in a stagflationary environment, one in which the Fed, with all respect to the toolbox, is sort of limited in its fight.
Yeah, I've been talking about the debt and the deficit for a long time, and here we are again with it on the course for fiscal 2025, I guess it is, to have a $2 trillion budget deficit plus again. And this is one of the reasons why I've been negative on long-term bonds. I just feel like there's just too much uncertainty about what ultimately is going to be the solution or the attempted solution at all of this stuff. The deflation part, I think, is there, obviously, with our forecast for the CPI to go over 4% on the headline number. That's a pretty big inflation rate when your goal is 2%. So, but the stag, I don't know. The economy's a little bit weaker. Jay Powell mentioned that. But I don't feel like the economy is anemic at this point in time. You've got manufacturing doing pretty well. Business investment might start to weaken with some data that's coming out, some news items on data center buildings and some vacancies and stuff like that. But I just feel like the consumer still seems to be in fairly good shape, and interest rates just still aren't all that high. Mm-hmm. So I think we have more of an inflation problem than an anemic growth problem at this point in time. And that's what the Fed needs to be focused on, and that's why I'm leaning towards a hike and not a cut.
So I'd like to end by asking you about a topic that we've spoken about numerous times. Speaking of warnings from smart investors, and that is private credit, a topic which you'll be speaking about, from what I understand, next week out at Milken. So a large room of thousands of people are going to hear what you've been telling us and our viewers for many months, your concerns. Are they as are you as concerned today as you have been? I mean, look, the economy is hanging in there. There were some pretty big negative bets being made on what software companies may do or may be unable to do, but probably better said, in the future. But where do you come down today on that, and what will you tell that room full of investors?
Well, I'm on a panel, which I usually don't do, but for Milken, you're kind of stuck that way. And I'm on a panel with 4 people that are all going to be very positive on private credit. So it's going to be 4 against 1. So I like my chances. I like my chances there. But I think private credit is a slow-moving problem, and the problem is not so much the defaults, although there's growing news of defaults. It's basically the trust factor. The trust factor has kind of faded away. I think investors didn't really well understand the liquidity limitations of these interval funds. And it's pretty clear that the marks are a little bit iffy on these things when you get news bombs, tape bombs of some sponsor marking down a position, 50 points or 100 points. This is not going to stop. There's a trust factor here that's a problem, because I think there's an essential mismatch between. I'm not that negative on private credit. I'm negative on these interval funds that are trying to do the unnatural. They're taking illiquid assets that everybody knows are long-dated illiquid assets, and they're offering liquidity on them. And that's not going to work. And so I'm more worried about just the exodus of money. People say, well, there's nothing wrong with these assets in private credit. It's just a liquidity problem. Well, that's what took down Silicon Valley Bank. They owned treasuries and Ginnie Maes. They didn't have any default problem. It was just a mismatch of assets and liabilities. And that's what private credit with interval funds has set itself up for. So I tweeted out several weeks ago, beware the Ides of June. And that's a pretty cryptic tweet, or X, or whatever you want to call it. But what I mean is June 23rd is the Ides of June. It has something to do with the moon phase. It's not always the 15th of the month. And I think you're going to get humongous withdrawal requests from these interval funds in June.
Oh, what the hell? All right, guys. So you got it there. You got it there. He thinks something's going to happen in June. So what did I tell you guys the last few shows? I said June. I'm always harping about June. If we're lucky, we get through June and we can go to July. But my expectation is something's going to happen in June. Options expiration, this and that. But Jeffrey Gunlock, the bond king, is saying there is some private credit illiquidity under the surface that will blow up and cause a problem. You know what? You know what might happen? Let's say we get into June, right? Something blows up. And then it will force the Federal Reserve to cut interest rates. There's going to be a crisis. The Fed will come in, inject liquidity again, and stop the panic. Okay? So let's see what happens in June.
And I think that's going to be a catalyst for more angst in the interval fund universe.
All right. Well, I'm sure you'll make headlines out in Beverly Hills. We'll follow that, and you always make them with us, so we're appreciative of you being with us every Fed day. Next time, we'll just do it with a new chair. Jeffrey, thank you.
So that new Fed chair is going to have a hell of a time. Oh, man. So this is usually what happens. Like there's a crisis and the Fed backs off, right? The Fed acts tough. They talk tough. And then something goes wrong with the financial plumbing and they back off. That's what happened in 2019. So if you remember 2018, there was a crash that started happening at the end of the year. The fourth quarter of 2018, stock market went down. What was the reason? There wasn't any real reason for stocks to go down. What happened was the junk bond market started crashing. There was some problem when the Fed started raising interest rates and started taking away the QE, right? The quantitative easing. They started taking away the bond market support. They were selling bonds. They were getting rid of bonds. They weren't buying bonds anymore. There was a problem with the junk bond market, and it spooked them. So in 2019, they backed off. They said, like, okay, we won't sell any more bonds. We're not going to raise interest rates anymore. Because you remember Trump was yelling at that time. Because every time Trump becomes president, he's always like, lower the interest rates, lower the interest rates. He did this so many times. He always tell the Federal Reserve to lower the interest rates. Because we've been living in the shadow of 2007, 2008. We've got used to low interest rates. This is what would they call this? A moral hazard, right? So you got people have gotten used to crack. Okay, this is the financial equivalent of crack. When you lower the interest rates to 0%, your mortgage rates go down to 2 point whatever percent, right? That's what happened in COVID. A lot of people bought a lot of houses then. Now people don't want to sell houses because they're afraid if they sell the house, they have to buy another house and it'll be at a higher interest rate. They don't want to sell the house. So they hoard the houses, right? So that exacerbates problems in the real estate market. So you get all this moral hazard all over the place. Okay, so anyway, yeah, we still live in the shadow of these things. Okay, let me show you this stuff here. All right, semiconductor ETF SOXX up 1.78%. Lumentum is down 5.64%. So whatever they're talking about in the earnings conference call is not doing well for that. But AMD, however, is continuing on up 12%. Okay, so AMD is fine. It's going to lift everything up tomorrow for semiconductors. Okay, Lumentum is the first a major optical one we've had. Actually, like yesterday, Fabrinet reported earnings and that went down. So I think the whole day we've been down 0.8%. We were actually down way worse pre-market, but it bounced. So you can see like in the early mornings, we were down nearly 13%, but it bounced. So we'll see how Lumentum behaves. Lumentum is very important for this. And then we'll have two more. Coherent, COHR. It will report tomorrow after the close. I think it'll be afternoon. And then AOI Thursday, I think, after the close. AOI. So these kind of are like the high flyers of the optics. These are not semiconductors, but they will influence like the AI stuff we're talking about. Okay, so all the AI tickers I want to jump into, they might affect it, they might not, but I think I don't really care about where semiconductors are going to go right now. I think this is about the end. You're not going to have NVIDIA earnings until 2 weeks. So that's the last major semiconductor one for a while. Okay. So if there's some Iran stuff or whatever, expect this to pull back again. So this is the semiconductor ETF SOXX 15-minute chart, and we've already hit the target today at 477. After this target, the next target will be 500 something. All right, I don't know if it's going to go right to 500 something. I don't think so. So if you want to short semiconductors, you can do it tomorrow morning. Get back in there. Go short it because AMD is it. AMD is going to be the last one. So let's see what happens at the open. You can go buy SOXS. So XOXS, you can buy this ETF. Okay, so this one it's going to be $10.94. Not bad. You can let's see if tomorrow it hits $10. I'll buy it. I'll buy it again. Whatever. Just for fun. But it's not going to be very important to me. Like this, shorting the market is not going to be important. I'll be looking at HUT tomorrow. So tomorrow we're going to look at HUT. HUT reports tomorrow morning. So wake up early for pre-market, see where HUT is, jump in, just like CIFR. So CIFR, HUT, all that. Yeah, we'll see it tomorrow. Okay, let's look at the gamma levels. Gamma exposure. So when you get to the green zone or the red zone, all right. If you're in the red, it's easy for it to sell. So this was as of 2 days ago. So gamma flip line is 476.9. Okay, so let's look back at the SOXS. Oh, whatever. Let's see. 491. So we're back up here. Okay. So the next target will be 500 something. So we're well in the green zone. If we fall back below around like 480, okay, that's when shorting it really makes a lot of sense. So watch this, how this acts tomorrow. If this thing starts rolling over, so it pumps in the morning and then it starts pulling back into 480, that's when you know this might be the end for semiconductors. Hopefully that means we can go into HUT and all the other ones. IGV. So IGV is a software select sector. It's well in the green. So we're pretty safe here. If we can break out of 90 on IGV in the coming days, that's good. That's good news. Software is going to go up. QQQ, NASDAQ 100. So we're above the 665 for the Gamma Flip. S&P 500 is not... it's borderline. So there was something on Twitter that I reposted on Twitter. It said like if we went down 1% on the S&P, we would start like really selling off. If, however, we went up 2%, we would start going up like crazy. So if we went down 1%, we would drop like crazy. If we went up 2%, we would go up like crazy. Okay? So watch out for that. XBI, like I said, I like the healthcare biotech stuff. Okay, if we can break out, we will go up pretty high. Okay, so let's look at the cycles over here. So early cycle, mid cycle, late cycle. So this is like the business cycle, right? And the stock market cycle. So stock market is about like 2 years ahead of the business cycle, or 1 year, 2 years ahead. And if we're entering the late cycle, mid to late cycle, what you're going to start seeing is real estate start outperforming. Consumer staples start outperforming, like consumer staples like, you know, Palmolive, Colgate, Coca-Cola, McDonald's, whatever. I guess McDonald's. Well, okay, I guess McDonald's is consumer staple. Okay, energy. I mean, America definitely runs on junk food. Okay, energy. That's definitely the one, right? You start seeing more oil and gas companies. That's why I said like oil, gas companies, I'm very bullish on in the long term. In the medium, short term right now, I'd rather be an AI. Okay. I think you can. I told you guys like 3 months ago, right, to jump, or 2.5 months ago by now, to jump into oil and gas. I didn't expect the Iran stuff, really. It didn't matter to me, but it pulled everything up. It pulled everything up forward. But so that means like there's going to be a lot of good. Natural gas will be the one I would be looking at. Natural gas is my favorite out of everything else. So because America really is undervalued in terms of natural gas. If we start building a lot of infrastructure for ports in Louisiana, right, in Texas, Corpus Christi, there's going to be a lot of natural gas ports. We can export a lot of natural gas. Then we will take over from Qatar, okay, and the UAE and Oman. So the Gulf states exported a lot of natural gas to Europe. Because of the Hormuz Strait, that benefits us. So if the Hormuz Strait never returns back to normal in any short period of time, then the U.S. natural gas companies like will take over. So there you go. And then the last one is utilities. Utility stocks will be the next one. And I think there's the New Jersey, Mid-Atlantic utility stocks, Florida utility stocks, NEE. There's going to be some utility stocks I'll start mentioning as we move along. So this is a 200-year technological transformation. You can see like, okay, we have different eras where technology changes have a big boost in the markets over time. So first is rail, all right, railroads, and then we have electricity and steel, all right, and then we have automobiles and I guess factory work, okay, like Henry Ford, so heavy industrialization. And then after that, we have the dot-com IT boom, right? So now we're entering the AI, I guess. Could be, maybe. So we're kind of like the early stages of this. So we will have like an early blow off, and then maybe we'll have a little financial crisis, maybe a little war with China over Taiwan. I don't know what's going to happen. Something's going to break this. So we'll have like a little break. Like you can see, like automobiles had a big boost into World War One and World War Two, and then when we had the World Wars, we had a crash, and then we continued on up. So maybe that's what's going to happen. We are going to have like a boost up in AI, and then we're going to have a little war with China, and then it goes down, and then we can continue on up. So maybe it's going to act like this automobiles mass production type of behavior here. So we have initial boost because we're learning how to make cars, internal combustion engines. We're learning how to make airplanes. And then we go to war. And then we go and continue on after the war. So I think we're going to have like a lot of cyber warfare. Maybe it's not going to be as crazy as the World War One, World War II scenario. We might just have like kind of like a Cold War plus plus type of scenario where we kind of treat China like Russia and we just have cyber attacks on each other. I don't know. Yeah. Yeah. So there we go. All right, guys. Next one. Yeah, that's it. That's all I want to talk about. Good. Covered that. Okay, so I'm going to play this JB Hunt video. I've been meaning to play this for a while. I think if Bull is still here, or Built to Spill, my bad, Built to Spill. Yeah, maybe she can comment on this video that the algorithm blessed me with.
Truck stop in America tonight at 2 a.m. and you'll see the same scene. A tired man or woman eating alone at a Waffle House counter. A row of rigs outside, most of them with over 600,000 miles on the odometer. Paint faded, engines rumbling, drivers who haven't seen their families in 3 weeks. You've probably looked at that scene and thought, yeah, that's just what trucking is. A grind. A hard life that people choose because they didn't have better options. But here's the thing, almost nobody knows. In 1980, the average American trucker earned the equivalent of about $131,000 a year in today's dollars. They owned homes. They took vacations. They put kids through college on one paycheck. It was one of the best blue-collar jobs in the country. And then, in less than a decade, that entire world collapsed. Ask any long-haul driver over 55 why, and most of them will name the same man. An Arkansas sharecropper's son who dropped out of school in the 7th grade and built the largest publicly traded trucking company in America. The popular answer is deregulation. But deregulation didn't ruin trucking. Somebody figured out how to weaponize it. The answer has 3 layers. Most people only ever hear the first one. And the whole thing connects to something you carried into your kitchen this morning. But to understand how one man broke an entire profession, you have to start with what made it great in the first place. Go back to the late 1970s. A truck driver in Chicago or Detroit or Pittsburgh was not a hard luck figure. He was a middle-class union man with a seniority number, a pension, and a house in a decent neighborhood. Under the 1935 Motor Carrier Act, the federal government had locked the entire trucking industry inside a rate-regulated system. The Interstate Commerce Commission decided who could carry what, on which route, and at what price. A single trucking route, for example hauling dry goods from Chicago to Kansas City, could sell on the private market for over $1 million. That is how valuable a protected freight lane was. And inside that system, the Teamsters were one of the most powerful unions in America. The National Master Freight Agreement covered roughly 500,000 drivers across nearly 1,000 carriers. Wages for ICC regulated. Unionized truckers ran about 50% higher than comparable blue-collar jobs in other industries. So why did the government break it? Because by the late 1970s, inflation was eating America alive. Gasoline, groceries, everything cost more every month. Economists pointed at protected industries, and said if competition were allowed, prices would fall. President Jimmy Carter agreed. On July 1st, 1980, he signed the Motor Carrier Act of 1980. On paper, it was a modest reform. In practice, it was a starter gun. The act made it dramatically easier for new carriers to enter the industry, let truckers price freely within a 15% zone, and ended route protection almost overnight. Within a decade, the number of licensed carriers more than doubled, exceeding 40,000 by 1990. Most of them were small, non-union startups paying a fraction of what established firms paid. The old giants, Consolidated Freightways, Yellow Freight, Roadway, thought they would survive by adjusting. They had pension obligations, union contracts, legacy cost structures. They could not cut fast enough. Truckload shipment rates fell 25% between 1977 and 1982, adjusted for inflation. That is a brutal number. That is an industry where every carrier was suddenly competing for the same freight at cheaper prices with no wage protection underneath. But here's what almost nobody saw coming. The companies that thought they were competing in a deregulated market were not really the threat. Out in Lowell, Arkansas, a lumber salesman turned truck driver had been preparing for this moment for years. And he was not going to play the old game better. He was going to rewrite the rules of the game entirely, in a way the legacy carriers could not copy, even if they wanted to. To understand why his version of trucking spread everywhere, you have to understand the trick he pulled, one that nobody else was willing to pull. Johnny Bryan Hunt bought his first trucking operation in 1969. 5 tractors, 7 trailers. It was a sideline to a rice hull business he and his wife Johnelle had started in Arkansas 8 years earlier. For most of the 1970s, his trucking outfit was unremarkable. By 1983, it was the 80th largest trucking firm in the country, solidly mid-tier. Then something happened that looks almost impossible on paper. Between 1980 and 1990, J.B. Hunt Transport Services grew by 2,000%. By 1987, it was the largest publicly traded trucking company in the United States. So what did Hunt do that nobody else had the appetite to do? According to industry records archived at encyclopedia.com, his strategy is documented in one brutal sentence. He moved to replace privately owned and operated rigs with his own non-union drivers and equipment. That one sentence is what broke trucking, because Hunt did 3 things simultaneously that the legacy firms could not. First, non-union labor. He recruited heavily from rural Arkansas, from small southern towns, from places where Teamster organizing was weak or non-existent. No union dues, no master freight agreement, no seniority pay scale, no pension contributions. Drivers who would run hard for a fraction of what a Chicago Teamster earned. Second, an owned fleet. Most competitors leased their rigs from independent owner-operators at fixed rates. Hunt bought his own trucks, so he controlled costs top to bottom, fuel, maintenance, scheduling, depreciation. Third, fuel discipline. Fuel was roughly 16% of revenue, and Hunt paid monthly incentives to drivers who kept the needle at 55 miles per hour. Small habits, massive aggregate.
Oh man, he got to the drive at 55 miles an hour forever. This is great. This is great. Oh man, I haven't watched this. I just got this on my feed like a week ago or something. I meant to play this. Yeah, I mean, because Built to Spill was like, Built to Spill. We had a trucking show in the early morning with a trucker, HB. It was me, HB, and oh man, I don't know. It would be great if you called in. Like, you could talk more about this stuff. I mean, I don't want you to dox yourself though. I think you kind of revealed enough that it's just like it's probably not a good idea to like talk on panel, but it would have been nice. It would have been nice.
Savings. But here's what made this devastating to competitors. The legacy union carriers were locked into contracts they could not escape. Teamster wages, pension obligations, work rules. While Hunt ran lean out of Arkansas, they bled. By 1982, 183.
All the links are in the description. So as much as I can, I put everything in the description. So you can go to this. If you're on Kick, you got to go on YouTube and you got to find. It's the same channel name. If you're on Kick, Give Crack to Me. So and here, let me put this. Okay, let me put this on there. Here you go. In the chat. Okay. So it's in the chat, but yeah, it's in the description of the video.
Unionized carriers had gone out of business. 30% of freight Teamsters were unemployed. Teamster President Jackie Presser, watching his members starve, proposed a 1983 relief rider that would cut wages by up to 35% just to keep carriers alive. The rank and file voted it down, 94,086 to 13,082. They were not rejecting reality. They were delaying it by 5 years, because the savings Hunt unlocked did not stay in the trucking industry. They became the price tag on nearly everything in your fridge. But we will get to that. Here is the part that hurt drivers even more than the non-union model. Sociologist Steve Viscelli, in research published in The Atlantic, documented how the Hunt model accelerated another shift, misclassifying drivers as independent contractors. On paper, they were small business owners. In practice, they were employees who had to pay for the truck, the fuel, the insurance, and the maintenance themselves. By 1998, drivers were earning 30 to 40% less than their predecessors before 1980. And in Atlanta alone, average hourly trucker earnings dropped 31% between 1980 and 2017. The Berkeley Labor Center later found that over 1/4 of independent contractor truckers are misclassified, including drivers for FedEx and Amazon. Some lease purchase contracts lock drivers in so tightly that walking away can cost up to $65,000. One economic expert told Business Insider, the clearest line anyone has ever written about this model. The prices of trucking got cheaper, but the ability to make a living evaporated. But Hunt's most consequential move was not about drivers at all. It was about something sitting right next to the highway that every other trucking company had treated as a mortal enemy for a century. But here's where it gets genuinely strange. For 100 years, trucking and railroads had hated each other. When the interstate system went in during the late 1950s and the 1960s, trucks took freight away from trains at a speed the railroads never recovered from. By the late 1980s, the two industries looked at each other across the highway like two boxers who'd agreed never to touch, until a man named Mike Haverty, president of the Atchison, Topeka, and Santa Fe Railway, did something nobody in either industry thought possible. Haverty had written a business school thesis arguing that trains and trucks should combine forces. Trains for the long-haul miles, trucks for the first and last leg. Everyone he pitched it to told him the same thing. Railroad companies and trucking companies hate each other. It won't work. In 1988, Haverty visited Hunt in Lowell, Arkansas. The next year, he invited Hunt onto a Santa Fe business car for a train ride from Chicago toward Kansas City. Somewhere around Galesburg, Illinois, according to Haverty's own account, Hunt walked over and said, "Haverty, we've got a deal." On February 5th, 1989, the first J.B. Hunt trailer was loaded onto a Santa Fe rail car. The service started absurdly small, 150 trailers and 5 rail cars moving freight between Chicago and California. And that handshake is why half the stuff in your house got cheaper, because the economics rewrote the entire freight map. A trailer on a rail car uses a fraction of the fuel of a pure, long-haul truck. Crucially, it also needs fewer drivers to move the same freight the same distance. Every container on a train is a long-haul driving job that simply doesn't exist anymore. By 2008, the J.B. Hunt and BNSF partnership was moving more than 700,000 shipments a year. By 2024, J.B. Hunt owned roughly 132,000 intermodal containers, the largest intermodal fleet in North America, with a target of 150,000 by 2027. But here's the part nobody told the public. When long-haul trucking jobs turned into short drayage jobs, quick runs from a rail yard to a warehouse, the pay structure collapsed to match. A drayage driver in Long Beach or Chicago doesn't earn what a cross-country teamster earned in 1980. Not even close. And that's before you even get to the Walmart piece. In April 2000, J.B. Hunt signed a contract with Walmart worth over $100 million a year to handle 31 of Walmart's distribution centers. Walmart had been using roughly 50 separate carriers. Hunt replaced all of them. That consolidation play became the new normal. Give the largest shipper the largest carrier, and watch everyone in between get squeezed out. 24 years later, in February 2024, Walmart handed over its entire intermodal fleet, roughly 15,500 containers, to J.B. Hunt in a long-term deal, because Walmart's internal operation cost more than Hunt's network did. Once the largest retailer in America runs on the Hunt model, every other retailer has to match Walmart's shipping costs to compete. Therefore, every other retailer's carriers have to match Hunt's costs, which means cutting wages even further. And that's exactly why the ripple effect you are about to feel in your own budget goes deeper than you would ever guess. Now pull back and look at your daily life. Almost every box you didn't notice arrive is riding on top of the Hunt model, your Amazon Prime order. Amazon Freight and its subcontractors run the template: independent contractors, non-union, paid per mile, lease-to-own trucks. The FedEx ground driver who dropped a package at your door this week is an independent contractor. An Amazon DSP driver is an independent contractor. The template for how those jobs are structured is Hunt's template, ported across the logistics industry. Walmart's everyday low price, the whole reason Walmart beat Sears, Kmart, and every regional chain on the map, rests directly on the contract architecture and intermodal shipping costs Hunt pioneered. Every overnight grocery restock at your local store rides from a port or factory on a train, offloads at an intermodal yard, and comes to your store on a short-haul driver making a fraction of what his predecessor made in 1980. You've been living inside Hunt's model your whole adult life without knowing what to call it. The fact that you can get a couch shipped from California to Maine for less than the cost of a dinner out, that's the Hunt model. The fact that a t-shirt that crossed 2 oceans costs less than a sandwich, the Hunt model enabled it. But here's the part that should stop you cold. The American Trucking Association keeps warning about a driver shortage. Currently around 80,000 drivers, projected to hit 160,000 by 2030. It is not a shortage of people with commercial licenses. It is a shortage of people willing to drive for the wages Hunt's model made the industry-wide baseline. Annual turnover at the big truckload carriers runs above 90% most years. Drivers rotate through the system like a conveyor. In 1980, a unionized trucker made the equivalent of about $131,000 a year, owned a home, and took vacations. In 2025, the typical long-haul driver earns around $50,000 to $55,000, works more than 60 hours a week, and sleeps in the cab behind his seat. One profession collapsed. The savings became your grocery bill. So what are you actually looking at when you see that tired guy at the Waffle House? Here is where you actually land. You pulled into that truck stop thinking you were looking at a tired trucker, a hard life, a bad career choice. But what you were actually looking at was a 45-year-old deregulation law signed on July 1st, 1980. An Arkansas sharecropper's son who saw an opening nobody else saw, a handshake on a Santa Fe rail car near Galesburg, Illinois in 1989. A Walmart contract that rewrote how every American retailer ships freight, and a pay cut that started in 1980 and never stopped. That man alone at the Waffle House at 2 a.m. is not a bad life choice. He is living inside the business model that built your grocery bill. J.B. Hunt did not ruin trucking in the sense of destroying it. He built something so structurally efficient that the old version of trucking, unionized, rate-protected, middle class, could not exist alongside it. The industry did not die. It mutated. And every cheap thing you own rides on top of that mutation. You are not just looking at a broken profession. You are looking at the invisible machine that made American consumerism cheap, and the people who paid for it so you did not have to. And if you think the story of how one man quietly reshaped trucking is strange, wait until we get into what happened the day one executive at a single American steelmaker did the exact same thing to...
All right, guys. Anyway, I hope you like that. I think that was very good, very enlightening. Okay, very enlightening. I mean, we live in a new age now, so we live in a post-COVID era. We have nearshoring and all that, so we're gonna have to an Amazon Prime, right? We got a new entry into the competition here. All right, so here we are. This is a tweet So look at Amazon Logistics. So right now, Amazon Logistics. So I don't know if you guys been driving the interstates, but every time I go on there, I see more and more Amazon trucks. All right, and I think, I mean, how far we've gone on this data point here. Looks like we've only gone to 2024. We're already in 2026. I wonder how big this is compared to the U.S. Postal Service. So in 2024, we got 28% on Amazon Logistics. UPS down to 21%, FedEx down to 17%, and the USPS, which is kind of like a short haul or city-based delivery service arm for Amazon at this point, is 31%. So yeah, interesting. We're living in different times. Oh, JB Hunt has Amazon trucks white label too. Okay. So, man, I wish we had our trucking show. This was 2 years ago. We had our early morning trucking show. It would have been a lot better had we had some truckers on there talking about this. Mo. I don't know when you watched the Thorpes Built to Spill. I don't know when you started watching the Thorpes. There was a popular, regular chatter, Mo. He came on our show too, and so we had like 3 people trucking, and on our panel we had 3 of them put their dash cam on panel, and while we were talking. So it would have been nice if we kept that show going. We had like a bunch of truckers bored and would just call into a panel show, and they would just be driving and talking at the same time, on the show. And then we could just discuss this type of stuff. Yeah. That would have been fun. Oh, well. So I'm pretty ignorant on this. So I have no idea what this means. Department of Transportation doing road checks next week, affecting everything in America, goods getting to places. Okay. Ton of money on what they call ELD software for trucking. Interesting. Yeah, this was like the early beginning times of the John Galt channel. So at the beginning, it was just me and John Galt talking about software stocks. And then we had HB come on, and then he would do an early morning trucking show. So when he would start driving around like 3 a.m., 4 a.m. East Coast time, I would just jump in. It's like basically 1 a.m., 2 a.m. my time, and we would be there talking. Okay, that's how it started. And then we would have a 24-hour show, because in the morning we would be doing that, and then later on we would have politics, and then urban landlord. Yeah. So, and at one point we had 3 people on dash cam. Yeah. Mo, and Lowe's brother-in-law. I forgot his name. It was a big drama. So I don't know if you know Lowe. Riding High with Lowe. I don't even know, like, when did you actually start watching the Thorpes or any of that? I don't actually remember when you even came into the thing. Did you just watch Jeremy stuff first? Is that what it is? Fuck, who's that? Damn, I forgot his name. He was like a Hotep black dude. I don't know. He did short haul in Southern Carolina or whatever. I mean, and then we had long haul with HB, and then Mo would be like driving back and forth like between Florida and like whatever. Yeah, sir. There we go, sir. Yes, sir. With 2 eyes. Holy shit. He never showed his face on this channel again after that shit. He's on CT sometimes, but he never showed in there. When Grace went to LCU. Oh, is that how you got in? Yeah, you were too late then. By the time Grace went to LCU, it was over for us. Yeah. That was the end. So, all right, guys. Let's see how much time I got left with you. I already did 2 hours, 20 minutes. Maybe Plate Gang. Damn, you come from some side. You come from some side stuff. Do you remember Ethan Ralph? So I came from Ethan Ralph. Okay. Ethan Ralph, and then like Kino Casino. Okay. So kind of like that PPP stuff. And people were talking about the Thorpes, because there were a lot of people inside that Chinatown stuff. Talk about the Thorpes, and those Chinatown people were in. So that's how I got involved, I guess. Oh man, you can always tell who's new to Boyd because they sympathize with the dorks. Oh, and yeah, I could tell because if you're in Plate Gang, you're definitely not new, but you're kind of new with like the black channels, So yeah, so this is like when I jumped to the black, when the Thorpes started interacting with the black panels, that's when I got involved over here. Yeah, so I made my little home on this side of the internet a little bit, and then I started this stock channel. I don't know. I guess I'm bored. Whatever. Hater Nation. Okay. Yeah, I wasn't really into that one, but okay. I got you. Mm-hmm. All right. So, okay, since we're talking about the Thorpes, let me show some stuff from the last couple days. I don't know how many of you guys caught up because I know a lot of you people haven't really been paying attention too much. So let me do a little bit of Boyd stuff before since I'm a couple hour away. I guess Deadman is going to stream, so he's going to catch you up on the latest that happened today. But I thought this was I'll play some clips. Let's see. Some clips. And we'll move from there. Huh. Okay. No, I don't want to play that. Let's see. If there's any clips. Okay. Let me play this one. Let's see what this one is.
I mean, the scooter thing was straight up dangerous, but whatever.
Yeah, but I'm saying outdoors, in terms of outdoors handling guns and stuff.
Oh, yeah.
But, like, he also knows that Jeremy, despite saying he's had, quote, a lot of experience camping, I've had some experience camping, and I can tell he doesn't know the first thing about what he's doing.
Mm-hmm. You said you were surrounded by bears on a group campsite at one point.
Yeah, and I was on a trip with the College of William and Mary, and we were in Virginia, which is not as much bear country, but we were in the woods.
Yeah.
And the bears howl at night. I had no idea what was going on at night, but I heard it.
Yeah.
And the next day they were like, oh yeah, that was what do they call it of bears? A group of, what do you call it? A pack of bears. And I
think so.
But because I was with people who knew what they were doing, they had all the bear safe everything and they pulled it up on trees so the bears couldn't access it. And the people running it, I think it was a woman who was actually running it. But, she's one of these people who had vast experience in the outdoors, and she was like, she taught us a lot even before going out there.
Mm-hmm. No, I believe you, yeah.
And, she would never have suggested, oh, this is super easy. That was not her point.
Yeah.
Although I did later a winter camping class with her, which was interesting because winter camping is much more dangerous. And her thing was like, it's not that bad, but don't be stupid. But
I got that.
I don't want Jeremy to be a cautionary tale. I think, and I don't want him to be on the news in Maine as, streamer thing that makes people hate streamers.
Yeah, right.
I also don't want him to create a wildfire that, even if he's not blamed for it, I don't want him to be an ugly American. I want him to be someone who, if he's going to do something, is respectful of others and himself. What's the likelihood that he's going to get mauled by a bear? Very low.
Right.
But even if bears come sniffing around, you end up calling the cops. The cops have to kill the bears now because they become acclimated, and they're going to, once they get, easy food from cars, like they're going to become now, that they're going to start looking for it again. So you have to kill these beautiful animals.
Yeah.
Magnificent creatures.
Beautiful beasts.
And it's not their fault.
Oh, so is this like the whole human man versus bear question or what? I don't know what's going on. So if what I know about bears is only what I know from Lake Tahoe. So if you're from California, there are some places in Southern California they'll get some brown bears, right? But mostly what I know is from Lake Tahoe. So if you go skiing in Lake Tahoe, you usually rent a cabin up there and in the winter. So winter time, you don't have to worry too much about bears. Spring, summer, if you go over to Lake Tahoe to do some boating, fishing, or whatever, then yeah, there's gonna be a lot more bears, right? And right because like wintertime they're hibernating. But the bears there are really smart, even during the winter. So I think during the winter, there's some bears that do not really go into hibernation mode, and because they've gotten used to learning how to open doors. So there was this like car or SUV or whatever, and the bears know how to open car doors. So they open the car door, they get in there, right? And then the car locks up from behind, right? Because they go in there and they shake the car, and then the door slams shut. They can't open it anymore because it's easy to open from the outside for the bears, but I guess inside, and the bear just tears up that whole car up. So it's like, what the fuck? So yeah, so bears are pretty smart, and these smaller bears in California, because we killed all the grizzly bears. Also, okay, so the grizzly bears of California, they've all gotten wiped out. They're extinct. We only have these small brown bears now. So, but Jeremy will be fine. That's not bear. Yeah, exactly. That's not bear country. That's not bear country. So whatever. I don't. Dude, the Northeast. I'm pretty sure all of them got wiped out. If there were bears there, they're gone now. Any aggressive bears, anyway. They'll be tame, whatever. Like, if Jeremy doesn't do some stupid stuff, should be fine. Ugh. Holy shit, the bears. Holy fuck. Anyhow, let's see what this is. There were some clips I clipped out on Kick.
You said he's a good-looking Chad? When did I say that? Roondog, you fucking asked me to send you a pair of... Hey, wait, hold on.
Oh yeah, okay. This is the rant that she went on with one of her I guess this person wanted some dirty panties for $200, but they didn't close the deal yet.
Dog, you asked me to send... You said you were going to pay me $200 for a pair of my panties, okay, dude? You are not one to be talking shit, yapping in the chat, okay, nigga? I don't want to hear it. You want a $200 pair of my stinky ass panties, and you're still asking for it in the DMs. So I don't want to fucking hear it from you about, hey, you didn't do a good enough job. You worship a pussy you've never seen and never will. So I don't want to fucking hear it, okay? I've had shit from the chat for 2 weeks straight, 4 weeks straight, 2 months straight. A fucking guy who's asking me for my fucking panties after I've worn them, begging me to ship them, saying he's gonna pay for me to get an Uber to the post office to ship them, from shitting on me in the chat. I don't fucking think so. I don't fucking think so, Roondog. You keep your bitch mouth shut, boy, until the panties are in them and you're sucking them down. Shut the fuck up. I doubt anyone wants your dirty underwear. You want to see the DMs? It's been months he's been asking. Okay? And I like him. But to shit on me after fucking gooning for me $200s for panties plus an Uber ride? I don't want to fucking hear it. Jesus Christ, what do I gotta do? This looks good. Salmon.
All right, supermarket overpriced sushi. Let's go.
Avocado. Awfully quiet. Oh, is Roondog here? You know, I kind of regret that because Roondog was kind of like a loyal viewer, to be honest. Sorry about that, Roondog. I didn't send him the panties. Like, I don't know. I kind of regret it. Ooh, salad. Tossed BLT, tossed, grab and go wedge, antipasto, spring mix berry salad with goat cheese.
Yeah, Ben tried to eat that stuff and he was like, that's nasty. So Ben does not like this salad.
It's definitely the move. What do we get with this? Spring mix berry salad with goat cheese. Balsamic, Thousand Island, honey Dijon.
Dude, I can't. Dude, OPC is just like, he's just dropping ammo and weapons to like streamers. Like, he just goes around in his little Jeep and then he's just like, let me do an ammo drop. Let me do like a gun drop. It's like, is this serious? It's like a real life game for OPC. It's like, yo, Jeremy, here you go. Here's some ammo. Here's like, oh, dude, he only gave Jeremy 2 shots and 1 shotgun. 2 fucking shells, all right? And 1 shotgun. That's it. That's all he gave him. Yeah, like a GTA side mission, exactly. Healthy food and Ben don't mix. Yeah, he just likes preservatives. He ain't gonna eat that shit. He's like, he just ate 1 bite and he was like, ugh, disgusting. Yeah, he's not used to that. He's not gonna eat that. Yeah, like GTA side mission.
What would you get? Oh, they have all these too. Ranch, raspberry.
Raspberry vinegar.
You think so with this? Yeah? Okay. Thank you. I wouldn't have been able to choose. Yeah. You passed on easy 200? For what? What are you talking about? What's this? Pot roast? Goondog's offer? Oh, yeah. I wonder if it still stands. I have to stop lashing out at people. I have to stop lashing out at people when I'm mad at other people. Anyways, yeah, it was kind of a good offer.
Oh, well, you know, somebody else will come around for it. Anyway, it looks like we got mashed potatoes, Brussels sprouts, and some roast beef or whatever. Ben is used to eating a bag of chips. He didn't. Dude, did you see the time he was on CT's panel and he was eating like, dude, it was like reheated oven. Oh man, potato like chips, right? Like potato, like fries. It was basically fries. So chips for you guys in the UK. It was reheated chips, like those thick. I think those thick cut chips. You know, those frozen ones you would get, and cereal. Like, who the heck would eat like? Oh my god, that looked nasty. I was like, dude, that's your breakfast? Frozen potato, like fries, basically, and freaking what the heck? What, I don't even know what cereal it was eating. Like Frosted Flakes? Like, I don't know. It was like, dude, I can't do that. I can't do that. I don't know. If I was in college, I don't think I was that hungry to eat to have to eat like that. Bro, anyway, it's nasty. It's like, yeah, eating that stuff will age you, man, so bad. All right, so let me see. See if I got another video for you guys. See how much time I got. Like Dead Man should be. Oh, I don't got too much time. Okay, never mind. It's almost 4 o'clock for me Pacific. Okay, we're done here. Let me see if Dead Man is gonna have a stream. So I'll give you the link. So he can go over like the latest Jeremy stuff. So Jeremy skinned a squirrel yesterday morning. He pretended to eat a squirrel. Spoiler alert. He tried to fool us with chicken. I mean, come on, dude, bro. At least you could put soy sauce or some molasses to color it up to make it look brown so that we wouldn't know it was chicken. It was white meat. Come on. Give me a break. That was terrible. Jeremy's streaming right now. Okay. I don't see if Dead Man's gonna schedule anything. Oh, okay. He's scheduling something. All right, Dead Man's gonna schedule something. Ben should start dumpster diving. Dude, dumpster diving is so lucrative. If you go to a college town, you know, I know Ruby like lives around Yale, so every time they move in and out, you can find some great stuff. A lot of those, I mean, especially if she lives around Yale, right? A lot of those rich kids are like, ugh, I don't want to move this trash, and they just dump it outside their dorm. You go pick it up. It's a great place. College towns, I love college towns. So when I lived there, you know, PhD student, I would just be like, "Oof, give me that stuff. Who is dumping oil? Are you talking about the Thorpes black tank or like the oil change? Like every time they did an oil change with OPC Don, they're like that. Or are you talking about real oil? Are you talking about the Brent crude? The WTI is oil crashing right now? Is that it? So that means like tomorrow morning, I should be really bullish on AI stocks, right? Right? So what's going on? So, I mean that means like I should be bullish, right? I should be really bullish tomorrow. Okay. Okay. Well, who knows? I mean, it could be anything. I usually don't trust like short-term movements. Like you could tell like the oil and all that is like short-term movements. So, yeah. So, anyway, here, let me give you the stream link for Dead Man. He's going to go over some stuff. JP Morgan lawsuit hits up. All right. And Jeremy's content, something about that. Okay. So it's Mr. Deadman DT. Go to this link here. Okay, there you go. So he'll start streaming in about 1 hour. All right. So you can go find him at Mr. Deadman DT. Okay, good. Let's go. I think tomorrow morning we'll see Hut. So Hut will be the stock to watch tomorrow morning. Okay, guys. Let's see what the. So there we go. So let me give you my list there. Right. So let's see. Hut, HUT. So let me see the freaking I think it's Hut G, right? Hut G. I mean, oh man, I didn't put that list on there. Whoops. Sorry, guys. Yeah, there is a leverage ETF for Hut. So tomorrow, look at Hut. Oh man, great. I didn't put it on the list. Okay, HUTG. Okay, guys, HUTG. So I guess I forgot about that. Oh man. Okay. So HUTG. I guess that's my bad. My bad. Hopefully you guys know how to use Google. So HUTG. Okay, yeah. So tomorrow we'll have earnings. I guess it'll be fine, right? If oil is already going down today, it's going to go down tomorrow morning, and all the AI stocks should have an easy time to go up. And then semiconductors, hopefully that's the end. That's the last pump in semiconductors. Tomorrow, AMD is it. You're not going to see any major semiconductors earnings until NVIDIA in 2 weeks. And that's it. So hopefully that money in semiconductors goes to HUT, IREN, you know, all the other ones we were talking about, ALPD, whatever. Yeah. All right. So hopefully that's good. You guys get it. Okay, so this stuff here in this text file is in the description. I guess I forgot to put HUGTG. I don't know why, but that should have been yeah, that should have been on the list. My bad. Tomorrow, hut in the morning. Okay, guys, see ya.